Today, we're digging into the latest from a company called Health in Tech, or HIT for short. And they're making a pretty huge bet that AI can finally fix one of the biggest headaches in the US economy, health insurance, especially for small businesses.
So here's how we're going to break this down. First, we're going to unpack the massive problem that HIT is trying to solve. Then, we'll get into how their AI-powered platform actually works. From there, we'll crunch the numbers to see if this whole thing is paying off, uncover what they call their secret sauce, and finally, we'll peek into the future and see what's next for them.
So first things first, let's talk about the problem. Because at the very core of the American healthcare system, there's this challenge that, honestly, has become a total nightmare for millions of small and medium-sized business owners.
I mean, this is the million-dollar question, right? So many business owners are just tearing their hair out over the cost and the complexity. And the answer? Well, it really boils down to the type of insurance plans they can actually get their hands on.
For years, businesses have been stuck with this really frustrating choice. On one hand, you've got your fully insured plans. They're simple, predictable, but you pay a steep price for that simplicity. On the other hand, you have self-funded plans. They are way more cost-effective, much more flexible, but, and this is a big but, they've been just incredibly complex and risky to manage. And that complexity? Well, for small businesses, it's been a total deal breaker.
And this chart, wow, it just lays it all out, doesn't it? Look at that difference. You've got a whopping 80% of big companies using these smarter, self-funded plans. But small businesses? They're stuck way down at 27%. That massive gap, that's where the pain is. That's where millions of businesses are just getting crushed by insurance costs.
So, this is exactly where Health in Tech enters the picture. They looked at that gap we just saw and thought, hey, we can fix that. And their solution wasn't to become just another insurance company. Nope, they decided to tackle it as a tech company.
Now this is absolutely the key thing to get. HIT is not an insurance company. They're not the ones on the hook for claims or risk. Not at all. What they've done is build a really smart marketplace, a platform that finally makes those cheaper, better, self-funded plans easy enough for a small business to actually use.
So, imagine it's like this central hub, or, an operating system for self-funded insurance. It connects everybody who needs to be involved. You've got the brokers selling the plans. You've got the TPAs. Those are the third-party administrators who handle all the nitty-gritty paperwork. And then you have the big insurance carriers who provide what's called stop-loss coverage, which is basically just a safety net for those really huge claims. The platform's AI then looks at all these moving parts and designs the perfect, most cost-effective plan for each business. It takes all that chaos and streamlines it.
And the engine under the hood? It's their own software called eDIYBS. And what it does is pretty revolutionary for this industry. It lets a broker get a real, actual quote for one of these super complex plans in just a few minutes. You have to remember, this is an industry that often still runs on faxes and phone tag. So getting a quote that fast, it's a complete game changer. And just look at this timeline. This really shows you how big of a deal that is. The old way of doing things, you see it on the left, you could be waiting anywhere from a couple of weeks to 3 whole months just to get a proposal back. With their system, a complex plan might take 2 weeks, sure, but a simple one, you could have a quote in 2 minutes. That's just a ridiculous improvement. Okay, so the tech sounds great, but is it actually working? Is it translating into real business results? Well, let's get to the bottom line. Let's look at the numbers, because 2025 was a huge year for them.
Okay, first up, the number that really made everyone sit up and take notice. 71%. That's their revenue growth for the full year.
I mean, that's not just growing, that's hitting the accelerator. And in real dollars, that translates to $33.3 million for the year. It's pretty clear the market is buying what they're selling. And when you look at this chart, you can see this wasn't just some one-off lucky year. This is an accelerating growth curve that's been building for a few years now. They're not just growing, they're growing faster. And based on what they're telling investors for 2026, they think this is just getting started.
And it wasn't just about revenue either. This was the year they actually became profitable, pulling in $1.2 million in net income. On top of that, they grew their network of partners by 34%, and the number of actual employees covered by their plans jumped up to over 22,000. I mean, you look at all the key metrics, and they're all pointing in the right direction.
So how are they doing this? What's their secret? What makes it so hard for a competitor to just come in and do the same thing? Well, they call it their unfair advantage. And as you might guess, it's all about the AI.
Yeah, the CEO, Tim Johnson, he actually explained it really well on their earnings call. He basically said, look, It's not just that we have a cool AI model. It's the combination of three things all working in sync that makes it so powerful. So let's break down these three pillars that build what you'd call their competitive moat. It's proprietary data, an integrated workflow, and an active distribution network.
Okay, so it all kicks off with their distribution network. That's all the brokers who are actually out there using the platform day in and day out. Every time they run a quote, they're feeding the system more and more proprietary data. And this is the good stuff, real HIPAA-governed underwriting data that nobody else has. That special data is like superfood for the AI that's built into their platform, making it smarter with every single transaction. And this creates this awesome flywheel effect, right? The more brokers use the platform, the better the data gets, the better the data, the smarter the AI becomes, and the smarter the AI, the more brokers want to use the platform. See? It just keeps spinning faster and faster, building an advantage that's really tough to catch up to.
All right, so they've got this amazing engine running. What's next? Where do they go from here?
Well, one thing's for sure, they are not planning to take their foot off the gas. Their official guidance for 2026 is a revenue target between $45 and $50 million. If they hit the middle of that range, that's another 43% growth. So yeah, they're feeling pretty confident about where things are headed.
So how are they going to get there? Their game plan has a few key pieces. First, they're starting to go after bigger fish, moving up market to larger employers. Second, they're rolling out new products, like a 3-year rate stabilization program, which is huge for clients who need predictable costs. All while, of course, continuing to grow that network of brokers and TPAs. And the big vision? To keep evolving the platform until it's a fully integrated, one-stop shop marketplace for everything. Claims, cost containment, the whole shebang. They want to be indispensable. And that really leaves us with the big final question here. Look, there's no doubt health and tech is solving a huge, painful problem. And their growth is really impressive. But can a tech marketplace, even a really smart one, truly untangle the decades of complexity baked into American healthcare? It's a huge question. For now, health and tech is one of the most interesting players to watch in a very, very big fight.